6 ways to grow your money with compound interest. Compound interest can be a powerful tool for growing your savings, but if not handled wisely, it can also lead to financial ruin. Think of compound interest as a financial superhero. It's the process by which you earn interest on both your initial investment and the interest that accumulates over time, eventually resulting in substantial growth of your funds. Compound interest is like planting a money tree. Every dollar you invest is like a seed that grows into a bigger and bigger tree over time. But to fully maximize the benefits of compound interest, it's crucial to educate yourself on the various investment opportunities available and choose one that aligns with your goals and risk tolerance. Given its remarkable capacity to enhance your wealth, compound interest could be one of the wisest financial decisions you make, and starting it sooner rather than later holds even better advantages. If you're feeling unsure about where to begin, you're in the right place. In today's video, we'll delve into the power of compound interest and highlight the top investments that can help you maximize its potential. However, before we dive into the specifics, it's crucial to understand what makes compound interest investing so effective. Compound interest investing is a game changer because it leverages the incredible effect of compounding. With compounding, the interest you earn is reinvested, making you even more interest on top of the previously accumulated amount. This cycle continues and continues, and over time, it results in higher returns. So the earlier and more frequently you invest, the greater the growth potential, as each bit of earned interest significantly increases your long-term balance. For instance, if you invest $1,000 for 30 years with a 5% annual interest rate, you would end up with almost $4,500, a remarkable return on your initial investment without significant risk. Even small investments can yield impressive gains over time thanks to compound interest. If you're looking to build a strong financial safety net, compound interest should definitely be a key part of your plan. With patience and the magic of compound interest, you can retire on a private island and live like royalty. So for those seeking to harness the potential of compound interest, here are some of the best investments to consider. Asset number 1. Certificates of deposit. If you're new to investing and want to immediately benefit from compound interest while keeping risks minimal, savings options like certificates of deposit, commonly known as CDs, are the way to go. CDs can serve as an excellent method for saving towards specific goals, whether it's a home down payment, retirement planning, or prudent financial management. These instruments offer the flexibility to select an interest rate that aligns with your requirements, with average rates hovering around 1.18% and the possibility of securing up to 4.75% annually in the best case scenario. However, the catch is that you'll have to place a deposit and maintain it for a specified duration to begin earning interest. What's more, the minimum deposit threshold of a CD isn't the same across all banks. While Ally Bank and Capital One offer CDs with no minimum deposit, Bank of America and Chase Bank require an initial investment of $1,000, and smaller banks such as Marcus by Goldman Sachs and US Bank require at least $500. For those with substantial funds, exploring jumbo CDs is an option. These typically require a minimum deposit of $95,000, and several banks usually offer the same interest rate as their traditional CDs with the same terms. However, you should carefully review the terms and conditions and remember that sometimes higher minimum deposits can yield higher interest rates. For instance, a bank might increase the rate by 0.01% for each additional $50,000 deposited. So if you want to make the most of CD savings, you'll need to set your financial goals, establish a time frame, and compare interest rates across different banks. Asset number 2. High-yield savings accounts. A high-yield savings account is a great place to store money between short-term investments. These accounts often provide higher interest rates than traditional savings accounts, potentially reaching up to 5.03%, with similar liquidity and safety. Even better, most of them don't impose a minimum balance requirement. However, it's important to note that interest rates can be subject to fluctuations, especially during economic declines. For instance, in 2020, banks made several adjustments to the interest rates of their high-yield savings accounts. Therefore, you should watch out for changes in rates and potential banking fees. With rising interest rates and inflation, money left idle in a non-interest bearing account is money lost. One of the key benefits of a high-yield savings account is that you can earn interest on your deposited money while also enjoying the safety and protection provided by the Federal Deposit Insurance Corporation. This insurance guarantees that your savings of up to $250,000 per account are secure in case the bank fails and will be reimbursed. However, unlike most traditional savings accounts, you might need to maintain specific minimum balances to receive the advertised interest rate. So you'll need to ensure that you choose an account within limitations you're comfortable with. Although CDs and high-yield savings accounts generally yield higher returns than having your money in a traditional savings account, they may struggle to keep pace with inflation. To stay ahead of the surging prices, you might need to explore more aggressive investment options like asset number 3, which is bonds or bond funds. Bonds and bond funds have held a prominent position in the world of investments for centuries, offering a consistent income source to investors aiming to offset the risks associated with the stock market. The most popular bonds are treasury securities, which let you lend money to the government and gain interest payments until the bond reaches maturity. But remember that you must reinvest the interest earned from a bond to make it grow even more. This way, the interest itself generates additional returns. Bond funds can achieve compound interest too, and they can even be set to automatically reinvest the interest they earn. So your money keeps growing without you having to lift a finger. While this might seem appealing, you should know that bonds carry lower risk than stocks, yet a higher degree of risk than holding cash. Some, like long-term corporate bonds, are riskier but offer more yields. Then there are US Treasury bonds, which are considered super safe because they're backed by the strong credit of the US government. Though bonds carry more risk compared to CDs and high-yield savings accounts, they can be a great choice if you plan on holding your investment for a long time. That's because the value of bonds can fluctuate during their lifetime. If interest rates go up, the bond's value might go down. On the other hand, if rates drop, the bond's value goes up. However, regardless of any fluctuations during its lifespan, you'll receive the bond's total value when it reaches maturity. So if you're looking for a reliable investment, bonds and bonds funds are ideal for you. Asset number 4, money market accounts. If you're aiming to reach your savings goals, a money market account is a fantastic investment option for you. These accounts offer interest rates that start from a modest 0.27% and go up to a generous 4.39%. This means you can have more money in your pocket without putting in too much effort, and there's almost no risk involved. Just like savings accounts, money market accounts are supported by the Federal Deposit Insurance Corporation, which means that if you have less than $250,000 in your account, your money is protected by the US government. Plus, most money market accounts don't have a minimum balance requirement, so you don't need to worry about penalty fees if you suddenly need to use your savings for a last-minute first-class trip to the Maldives. A money market account also makes it super easy to grow your savings. Gone are the days of getting meager returns on your savings account balance. With money market accounts, you can benefit from higher interest rates without putting your money into long-term investments or hiding it under your mattress. The best part? You don't even need a minimum deposit to get started. Asset number 5, real estate investment trusts. Real estate investment trusts, commonly known as REITs, are a great way to diversify your portfolio by investing in real estate without directly purchasing properties. A real estate investment trust is a tax-advantaged company that primarily invests in real estate. To benefit from tax exemptions, these companies are required by law to pay at least 90% of their taxable income as dividends to their shareholders each year. This dividend income can come from rent rent paid by property tenants, or even from mortgage payments on loans owned by the REIT. To maximize the benefits of compounding over time, investors must reinvest their payouts as they often do with their other dividend-paying stocks. Do REITs have a good track record? Since their inception by Congress in 1960, REITs have consistently outperformed the S&P 500 index with an impressive 18.8% average annual return in recent times. Moreover, their high dividend yields stand out in the stock market due to consistent cash flow from rentals and mandatory payouts. Real estate investment trusts also tend to have a lower correlation with other investment assets, which can help minimize portfolio volatility. Unlike direct property ownership, which demands hands-on management and financial commitment for repairs and maintenance, REITs offer a more hands-off investment approach. Furthermore, publicly traded REITs offer commission-free trading, distinguishing them from traditional real estate transactions that typically involve a 6% sales commission. While REITs can be an enticing investment opportunity, they aren't without risks. Their potential drawbacks include high debt loads that can affect dividends, dependence on market trends for growth, possibly unsustainable dividends, sensitivity to interest rate fluctuations, governance concerns, particularly in non-traded and private REITs, and high commissions with limited exit options in some cases. So if you're contemplating an investment in REITs, you should first assess your financial situation and seek advice from an investment expert. They can help determine if REITs are suitable for your portfolio and the appropriate allocation. Asset number 6, dividend-paying stocks. While stocks are an excellent investment to compound growth, dividend stocks may even be better. Over the years, dividend-paying stocks have gained significant popularity as a way to add an additional income stream to your portfolio. With the S&P 500 index typically ranging between 2 and 5% dividend yield, it would be wise to capitalize on stocks that offer monetary returns by simply holding onto them. Properly managed and reinvested, dividend stocks present an excellent opportunity for creating passive income. The advantage of these stocks is that they allow you to continue earning money through dividends irrespective of any decrease in the share's value. Of course, like any investment, risks are always involved, and stocks are no exception. Most companies that offer dividends above 8% might be on the decline, so you must do thorough research. This involves looking into their financial statements, understanding the current market conditions, and developing a well-defined investment strategy. Doing this will shield you from unforeseen setbacks. When investing in dividend-paying stocks, you must first understand the risks and opportunities associated with the company. With a little bit of due diligence and research on the stocks you choose, you can maximize profits and quickly become skilled at investing in dividends. Investing your money in a compound interest investment is a gradual yet powerful way to double your money over time. Whether applied to savings accounts, bonds, real estate investment trusts, or dividend stocks, this strategy can potentially turn a rookie investor's money into substantial wealth. So if you're looking for a way to make your money work for you, why not give compound interest investments a shot? Well, that brings us to the end of the video. Thank you for watching and staying with me till the end. If you have any comments or thoughts you would like to share, please do so in the comments section below.